Welcome to Jackalyze, where analysis meets instinct. Today's video lays the groundwork for smart trading. We'll explore what technical analysis is, how it differs from fundamental analysis, what a real strategy looks like, and why price action gives you a true edge in the market. Technical analysis is a method of evaluating markets by analyzing price charts and trading volume. Instead of focusing on external fundamentals like news or economic data, it focuses purely on how price behaves. It's grounded in the belief that markets are driven by human behavior, and that human behavior often follows patterns. All known information, whether economic, political, or emotional, is already reflected in the price. By studying these price movements, traders look for repeating structures, areas of interest, and momentum shifts. The goal isn't to predict the future perfectly, but to make high-probability decisions based on historical behavior. Fundamental analysis is all about the why behind price. It looks at earnings, inflation, interest rates, GDP, and other economic factors. It's used more in investing than in short-term trading. Both approaches have value, but for traders, price usually moves long before the fundamentals catch up. A trading strategy is a structured set of rules that guides a trader's decisions in the market. It defines how, when, and why to enter or exit a position, based on objective criteria. A solid strategy always includes a clear entry point based on setup conditions, a defined take-profit level or target, a logical stop-loss to protect capital, a risk-to-reward ratio that makes sense, and ideally, a positive win rate over time. Good strategies reduce emotional decision-making and turn trading into a repeatable and measurable process, not emotional guesswork. There are many ways to participate in the market, but most trading styles fall into a few core categories, based on time frame, risk tolerance, and decision-making speed. Here are some of the most common. Scalping. Ultra-fast trades, usually held for seconds or minutes. High volume, high focus, small profits per trade. Day trading. Positions opened and closed within the same day. No overnight risk, ideal for active traders. Swing trading. Trades held for several days or weeks, based on medium-term price movements and trend patterns. Position trading. Long-term trades driven by fundamental or macro analysis. Positions may last weeks, months, or even years. Algorithmic trading. Automated systems built with code and backtesting to make objective, emotion-free decisions. Copy or social trading. Following experienced traders or signal providers through shared platforms, ideal for those still learning. Each of these styles comes with its own rhythm, emotional challenges, and skill requirements. What works for one trader may not work for another, and that's perfectly okay. The key is to find the style that matches your mind, lifestyle, and patience. If you're not sure what fits your personality best, check out our previous video on trading styles and MBTI types. It's a great place to start. Once you've chosen a trading style, the next step is defining your strategy. A strategy is your system. It tells you when to enter, where to exit, and how much to risk. Here are some of the most common strategy types. Price action. This strategy is built on reading raw price behavior, without indicators. Traders look for structures like support and resistance, breakouts, rejections, and candlestick patterns. It's clean, fast, and grounded in market psychology. Indicator-based strategies. These use tools like RSI, MACD, or moving averages to generate trade signals. They can help simplify decisions, but most of them are lagging. That means they give signals after price has already moved. Great for structure and confirmation, but not ideal as standalone entry tools. Smart money concepts/ICT. A more advanced, institutional style approach. Focuses on market structure, liquidity zones, and the behavior of big players. Popular among traders looking for deeper, logic-driven setups. Breakout strategies. These look for sudden price expansions out of a range or consolidation. Useful in high-volume sessions, often combined with news or market open times. Algorithmic strategies. Fully coded systems that follow strict rules. No emotion, just back-tested logic. Great for traders with coding knowledge and discipline to maintain systems. Fundamental strategies. Usually used in position trading, based on macroeconomic data, earnings, news events, or long-term trends. More common in stocks, crypto, or forex where fundamentals drive long-term direction. You should know indicators can be helpful, but don't fall into the trap of chasing them. Most indicators are based on past price action. They don't predict, they react. If your strategy relies only on indicators, you may always be one step behind. Instead, think of indicators as tools for confirmation, not decision makers. The best traders read price first, and use indicators only to validate what they already see. What is price action? Price action is the study of how price moves, without relying on indicators. It's about reading the market in its purest form. Instead of chasing lagging signals, you focus on how price reacts to key levels. Support, resistance, supply and demand zones, breakouts, or fakeouts. With price action, every candle tells a story about buyers, sellers, momentum, and uncertainty. It's not about prediction. It's about reaction, seeing how the market behaves in real time and adapting accordingly. This is the foundation of our strategy. Before we talk about advanced concepts, we always start with price. While price action is the base, our strategy goes deeper. We follow a refined, institutional mindset, drawing from ICT and smart money concepts. This means we don't just look at what price is doing. We look at why it's doing it, and who's behind the move. Smart money trading focuses on liquidity zones, market structure shifts, order blocks, fair value gaps, and manipulation patterns that trap retail traders. ICT adds even more structure to this, like time-based setups, optimal trade entry, weekly profiles and kill zones. We don't chase random entries, we trade with intent and structure. We trade with intent, timing, and clarity, with the mindset of institutions, not the herd. Multi-time frame analysis. One chart isn't enough. We use multi-time frame analysis to confirm the bigger picture and refine our entries. Zooming out shows you direction. Zooming in gives you the trigger. This technique helps reduce noise and increase precision. Who moves the market? It's important to understand, retail traders don't move the market. Institutions do. Smart money operates differently. They create traps, hunt stops, and manipulate liquidity to build positions. When you learn to see their footprints, like order blocks, liquidity sweeps, or sudden reversals, you stop following and start observing. We don't trade against smart money. We trade with them. Let's recap. Technical analysis isn't fortune-telling, it's structured observation. Price action keeps you focused. Strategy keeps you disciplined. Smart money gives you context. And when all three align, you trade with confidence, not chaos. This is just the beginning. In our next videos, we'll dive deeper: candlestick psychology, support and resistance zones, multi-time frame setups, and real trade breakdowns. Subscribe to Jackalyze for smart insights, clean analysis, and honest strategy. Because we don't trade noise. We trade structure. Patience of a jackal, precision of a trader.